The bloodbath has just begun. As a matter of fact, it's just the first inning. Now, unless you've been living under a rock, you already know that the bloodbath is happening in the banking sector. But it's not just the banking sector, it's the entire financial sector. And while it looks like the Fed might have saved this right now, I'm going to tell you that it's actually just beginning. So I'm going to break this down. We're going to look at what is going to happen from here, how we're in a new paradigm. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss. Of course, I make these videos to change the way you think about money because almost everything you've learned is wrong. You know, Henry Ford, the father of the automobile, he said, if the American people knew how the banking system worked, there would be a revolution before the morning. Now, he didn't say there would be a revolution. He didn't say there would be a revolution tomorrow. He said before the morning, meaning if I heard tonight, I'm going to go revolt tonight. And that's exactly what's happening. So let me explain to you how this banking system works. And we're going to talk about why there's a revolution before the morning. And so I already did a whole video explaining how this set up. We'll link to it here. We'll put it in the show notes down below. So if you want to go figure out what happened, go watch that video. All right, I'm not going to dig into that. I want to talk about the actual structure and where this goes from here so you're protected. Okay, so basically what happened is a few banks started collapsing. Silvergate Bank collapsed. Silicon Valley Bank, SVB, was the big one that went down. Everyone started panicking. That's the short version of it. Why did it go down? We'll talk about that in a second. But I want to tell you a little story first. Story time. Not too far back in history. You know, I love my history lessons. We're going to go back to the 1980s in California to a little town of Glendale, California. And in Glendale, California, there was a fireman there. He was a fire captain, as a matter of fact. He was an arson inspector, and his name was John Orr. Now, John Orr was a very famous fire inspector at the time, and for over a decade, he was going around and, putting fires out and trying to figure out who started, how they start, and who started them. Well, it turns out that he was both the arsonist, the one lighting the fire, and he also worked for the fire department that was putting them out. Now, he got found out. He got charged with massive destruction and I believe murder because lots of people died in these fires that he started. The reason why I'm telling you that story is because that's the Federal Reserve. The Federal Reserve is the arsonist, and then they're trying to pretend to be the firemen at the same time. But the problem is the fires that they're putting out only cause the fire to be worse next time. So basically what the Federal Reserve does is they set the price of money by changing the interest rate. So when they bring the interest rate down, people borrow more money. More money gets created into the system. Then so much money is created, they inflate the money supply. Inflation goes up. And so then the arsonist, oh my gosh, inflation's so high, they move to then restrict the price of money, making more money more expensive by raising rates, tightening the money supply, and then it crashes the system. And then the system is crashed, so the fire of the system crashing, the Fed is forced to respond to that fire, and they then ease money. They lower interest rates and inject money again, and it's just constant boom, bust, boom, bust, boom, bust, boom, bust. So just to kind of run you through this real quick, 2008, they dropped rates to zero. Put a whole bunch of money into the system. Then inflation started raging. In about 2016, 18, 19, they started raising rates, and then the whole system crashed. So they had to lower rates. Of course, they blamed it on the pandemic, but the banking system actually seized up September 2019. 2019 is when the banking system freezed up. They had to put $50 billion in overnight. Then it was $75 billion, then $100 billion, then $200 billion. And by February of 2020, they were putting in $1 trillion a night to keep the system from going. Of course, it's a war that always covers this. This time it was a war on the pandemic, the war on COVID, and they were forced to lower rates. They kept them way too low for way too long. Many people on YouTube, like myself, were saying, whoa, this is going to be a problem. Of course, the Fed said, no, it's not a problem. We're going to keep rates low. We're not even thinking about raising rates. And they said, inflation is just transitory. It's going to go away. Finally, they said, okay, it's a big problem. We better do something. And so here they are putting out the fire they created by now raising rates. This time they rose rates at a faster pace than any time in history, and they've created a new set of fires that they're now putting out. Now, what am I talking about? So just real quick, from this 2020 pandemic stimulus between the Fed and the government, they put in about $11 trillion. Now, where does that $11 trillion go? Well, it goes out into the banking system. We get money, we keep it in the bank. The bank's balances swelled, and where do they put that? Well, they put it into treasuries. bonds. Supposed to be the risk-free asset because the government always pays their debts. The problem is that they put them into bonds when bond yields were at their lowest level because the Fed had lowered the rates. So they put all that money into bonds. As soon as the Fed started to raise the rates, the banks were losing money on those government bonds. Now, that's tier one capital. It's the best capital that you can have. The banks were losing money, but it was unrealized losses. Remember, you don't have a loss until you sell, and they weren't forced to sell. But then something happened. Something called a run on the bank happened, meaning people went and wanted to get their money out of the bank, and they were forced to sell their bonds, this time at a loss. They had to actually realize the loss. Now, what's important to understand about this is the first time per, some regulators that are now talking about this. This is the first time that it's a social media. They're actually calling it a Twitter-fueled bank run. So what's important to understand here is that we are in a new paradigm. I talk about it all the time. The world we're going into is not the world that we're leaving behind. We live in a digital world today. 2 new paradigm shifts, or really 3 new paradigm shifts that you need to be aware of. Paradigm shift number 1 is, to their point, this is a Twitter-fueled bank run. In the old days, we've had many bank runs in the 20s and 30s, way back in the 1800s. You would have to hear about it very slowly through the grapevine. It might be a rumor. Maybe you have to go drive to the bank, stand in line. Today, you can put up a Twitter post and reach millions of people just like that. And so everybody heard about this. But the second thing is that, again, I don't have to go drive to the bank. I don't have to go stand in line. I can see it show up on Twitter. I can open up my app. I can click a button and I can wire my money out. And that's exactly what's happened. As a matter of fact, customers withdrew $42 billion in a single day from the bank. Not standing in line. Good luck trying to get more than a few $1,000s of cash out of the bank. $42 billion was gone, and of course the bank didn't have it, and so they had to be taken over by the FDIC. Now, what some of our dear leaders are trying to tell us is that we need to probably pass some regulations against this. Maybe it should be illegal for people to talk about banks potentially collapsing. Maybe we should have, the SEC, Gary Gensler says, maybe we should actually have punishment for people who help instigate this thing. But I would just have to say, it was potentially Peter Thiel who knocked this over the edge. If he was responsible for this bank collapsing, maybe the bank was ready to collapse anyway. If the banks don't have your money to give you back, then maybe that's the problem that we should figure out. And of course, people are just starting to figure that out. The banks don't have your money. The FDIC is supposed to insure it. They don't have your money either. Now, the third paradigm that's happening here is, and maybe there's actually 4. So the third paradigm, and again, thanks to the Fed, they have raised rates so fast and so high that it became attractive for people. How much money do you make in your bank account? 0%, 0.5, 0.8%. But the Fed will give you 5%. I like 5 better than 0. So lots of people, I've been talking about it, taking their money out and putting them into short-term treasuries, less than 2 years. Don't put them into long-term treasuries. And I can make 5%. So a lot of people are just taking their money out of the banks and put them into treasuries. So if the banks don't get off of this 0%, they're going to have more of that. More and more people will pull their money out. Now, the banks take your money and then they go invest it. So they should be paying you, in my opinion, what the Fed will pay you plus a premium that they're making on those loans. But they decided to pay you nothing. It's their fault. So they want to continue to push this back onto us, like the housing crisis. People were greedy, bought too many homes. They want to push this back onto us that because people talked about a banking collapse, it led to a banking collapse. So we should stop people from being able to talk. That's their answer. The reality is it's the bank's fault. They didn't pay us any interest. People wanted to go to the treasuries. People knew they didn't have their money in the bank. They wanted to get it out before it was too late, and so they did. It's the bank's fault. It's not ours. So people weren't able to get their money out. And of course, this was Silicon Valley Bank. Of course, all the venture capitalists, the very politically connected, the potentially, shall I say, left Democrat side, very politically connected, made a bunch of noise. Now, if this was a Midwestern farmers bank, do you think they would have got the same attention? Most likely not. If it was a small oil and gas bank, do you think they would have got the same attention? Of course not. But it was Silicon Valley. They were investing into their ESG funds. And of course, good old Governor Gavin Newsom was one of the big proponents to bail out the bank. Of course, he did that without disclosing that he has ties with the bank. Oh, surprise, surprise. Of course, they're always trying to bail themselves out. Now, the problem is that 2 things. One, The reality is that most of these people that had money over the FDIC insured amount probably wouldn't have lost that much. They might have taken a 10 or 15% haircut, which, it's tough for them. But maybe it would have been the slap on the wrist that these people would have needed to figure out that there's risk, figure out that they should have a proper risk management. But instead, capitalism was killed. We bailed out the banks, we privatized the gains, we socialized the losses, we bailed out the banks, and this leads to moral hazard. The people that ran this bank, Silicon Valley Bank, knew better. They were from Lehman Brothers, where it crashed in 2008. One of them was from the San Francisco Federal Reserve. They had insider information. They knew better, and they failed to take even the most basic of risk management. And they were way more risky than the average bank in their investments. Way more risky than the average bank. So they should have gotten punished, but they didn't, and so we bailed them out. Now, what's ironic about this is that, good old Janet Yellen, our Treasury Secretary, in 2017, she was asked about the potential for another 2008-level financial crisis. And she said, quote, "Would I say there will never be another financial crisis? Probably that would be going too far, but I do think we're much safer. And I hope that it will not be in our lifetimes. I don't believe it will be," end quote. So she's saying that we won't have another financial crisis in our lifetimes. Now, she's pretty old. Maybe not in her lifetime, but what about my lifetime? Well, I'm here to say that we are having a financial crisis right now. Remember, the Fed is the arsonist and the fire department. They have raised rates with reckless abandon faster than any time in history. And they've been saying they are going to raise rates until something broke. A lot of people would ask, what is that break that would happen? Well, I would say it's here. The Fed is now broke. The Fed's a bank, and they're broke. The U.S. Treasury, the government, is broke. The interest rates have gone up so fast they can't afford to pay the interest on the debt. At the same time, tax receipts are plunging. Income down, expenses up. The U.S. Treasury is broke. They had to borrow almost $1 trillion just this first quarter. So the Fed's broke. The government's broke, and now the banks are broken. So I would say they broke. Now, the problem is that we don't know how many more tricks the Fed has up their sleeves, the little hocus pocus. And so they've created some new magic trick to give the banks liquidity. And basically what they've done is they said, hey, all your U.S. Treasuries that have lost money, we'll just make you whole. So you don't have any losses anymore. That'll plug the hole. But the problem is it's like plugging your fingers into a dam. And they've got so many fingers. Now they've got their toes, maybe even their elbows in the dam. They're running out of appendages. So this is not going away. This did not fix the problem. It's only getting bigger. It's only getting worse. The Fed is in between what we call a rock and a hard place. We've talked about this for a while. The new inflation print just came out, and inflation is still going up. But the Fed now has to ease to save the banks to backstop the depositors. So what does it look like when the Fed has to continue to ease and print money as inflation is going up? Well, my answer is it doesn't look good, which is why you can see gold and Bitcoin have both caught a massive bid. Everybody's looking for a safe place to run. Everybody knows that the game is up. And that's what Ludwig von Mises calls the crack up boom. And then suddenly everybody realizes that inflation is both permanent and intentional. And that's where we're at. It's time to get your money and put it into some other assets. Gold and Bitcoin are taking a bid, but let me know what you think. Are you going to buy some commodities? Are you going to leave it in the bank? Would you go into short-term treasuries? I'd love to hear what you have to say. Leave it in the comments down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down. That's okay. At least tell me why. That's what I got. To your success.